Hi everyone, good to see you again all. I hope you all will be fine. Please subscribe my channel for more latest and good updates. 6 high-risk stocks for aggressive investors. For investors who want to take some risk, these stocks could be set for large gains. After a brutal 2022, the stock market has returned to a more optimistic outlook in 2023. With stocks rallying, now might be a good time to take a swing at some more aggressive opportunities. These 6 higher-risk stocks have seen their shares underperform amid heavy volatility. There are various reasons for that, including high leverage, challenged business models and great uncertainty around a potential recession. Less than speak greater than. However, if these companies can get things right, they could be set to dramatically outperform the S&P 500 going forward. Less than speak greater than. These stocks aren't for everyone. But for people who can withstand volatility and are looking for significant upside, these 6 aggressive stocks could be the ticket. Unity Software Inc. Unity is one of the 2 primary independent graphics engines that power modern games. Developers like Unity because it is easy to learn but powerful. It also works across a wide variety of platforms. Developers can build a game in Unity and release it across PC, mobile, consoles, and even augmented and virtual reality. On that last point, Unity appears set to become a major player in the metaverse and augmented reality ecosystems. To give one example, Apple Inc. (AAPL) recently announced that Unity will be a key collaborator in developing apps for the new Apple Vision Pro mixed reality headset. In addition to gaming, Unity has begun to develop secondary uses for its graphics technology such as in architecture and modeling, e-commerce, and video animation. Unity is only marginally profitable and still has to improve its monetization efforts. But with the stock down more than 75% from its peak, aggressive investors could be getting a favorable entry point here. Sabre Corp. (SABR). Sabre is one of the 3 primary global distribution systems, or GDS, for the travel industry. Except for Chinese firms, almost all of the world's airlines and other transportation companies list their tickets through these GDS platforms. Travel agents, online travel sites and so on can view all the itineraries on offer from various airlines, pick the best option, and buy tickets through a GDS, with operators such as Sabre earning a small fee. Understandably, revenues collapsed during the pandemic. This was disastrous news for Sabre, which is heavily indebted and had just made a large investment in upgrading its information technology systems. This leaves Sabre in an interesting position. It has about $4 billion in net debt against a market cap of just $1.3 billion. Shares trade for about $4, a steep discount to their more than $20 per share price before the pandemic. If Sabre can leverage the travel recovery in its new IT systems to return to profitability, shares could skyrocket. EPAM Systems Inc. (EPAM). In theory, EPAM Systems shouldn't be a risky investment. The company is highly profitable and holds a large cash balance. Despite that, EPAM stock has gotten hammered, with the stock plunging more than 60% since its 2021 peak. The firm, for those unfamiliar, is an IT consulting shop. Typically, Fortune 500 companies hire EPAM to develop and maintain key pieces of their IT backbones. EPAM's key innovation was taking advantage of labor arbitrage by hiring software engineers in Eastern Europe while charging high rates to service companies in wealthier markets. This strategy hit a major obstacle in 2022 with the invasion of Ukraine, as EPAM had around 40% of its employees in Eastern Europe when that war broke out. EPAM is rapidly diversifying its workforce, hiring more employees in other regions. However, the market seems unconvinced that EPAM will return to its traditional double-digit annualized earnings growth anytime soon. If it does, EPAM stock should soar from its current low point. The stock currently trades for about a third of what it did in its halcyon days when it traded for $700 a share in late 2021. UWM Holdings Corp. UWMC. United Wholesale Mortgage, UWM for short, is now America's largest mortgage lender. It gained the title in 2022, as its aggressive pricing strategy allowed it to overtake key rivals such as Rocket Cos Inc. (RKT). Now, to be sure, this isn't the best time for mortgage lenders. The surge in interest rates has caused a sharp drop in the market, with refinancing transactions in particular disappearing almost completely. UWM's profitability has plunged, and the company's juicy 6.2% dividend yield could be in danger if the firm's profits remain depressed. It's understandable why people are nervous. On the other hand, housing and interest rates are both cyclical, and things will swing back in UWM's direction sooner or later. And the housing market hasn't dropped nearly as far as bears had expected despite the unfavorable interest rate environment. UWMC stock trades well below its initial price, and 24% of the float has been sold short, which could make for prime short squeeze conditions. This makes for an interesting trade opportunity for aggressive investors. DocuSign Inc. (DOCU). 2023 has brought recoveries for a large chunk of the software industry. But some names haven't come back to life yet. DocuSign is one such case. Shares linger in the $50 range, down more than 20% over the past year and more than 80% since their 2021 peak. For a time during the pandemic, DocuSign enjoyed a tremendous surge in adoption as folks needed to take care of paperwork remotely. The return to the office has slowed this trend, however, and investors have moved on. That said, DocuSign's business is still in fine shape. Analysts project that revenues will rise 8% this year to $2.7 billion. The company is also comfortably profitable, with shares trading at just 21 times forward earnings. DocuSign's exponential growth phase has ended, but the company has a strong business model and decent forward prospects. Investors who can endure the terrible short-term sentiment now should be duly rewarded. Ubiquiti Inc. (UI). Ubiquiti provides internet hardware, selling items such as Wi-Fi routers, home security smart devices and enterprise-grade network equipment. It also offers software solutions that integrate with its hardware products. Ubiquiti was founded by a former Cisco Systems Inc. (CSCO) executive who has been disrupting the market both with new products and unusual marketing tactics. Some analysts have panned Ubiquiti due to its unorthodox strategy, but it's hard to argue with the results. UI stock is up more than 700% over the past 10 years. Despite that, the stock has fallen more than 50% from its 2021 peak amid the slowdown in the tech hardware industry. This marks an opportunity for aggressive investors as short interest remains high. Meanwhile, revenue growth is expected to rebound to 15% per year going forward. Thanks, take care.